Good afternoon. I want to thank everybody for logging in and calling into our webinar today on real estate investing with a 401k plan. During today's webinar, we're going to focus on how you can use your retirement funds to invest into real estate and other types of real estate related assets. During today's webinar, if you're listening live, you can type your questions into the chat box on the screen. If you're listening to a recorded version, please jot down your questions, and my contact information will be here on the end of this presentation. You can reach out to us with any questions that you have. My name is Scott Maurer. I'm the Director of Business Development here at Advanta IRA, and I've been with the company for almost 12 years now, coming up on a 12-year anniversary next February in 2018. I've been with the company again since 2006. It's been so long. I've been with the company for that long. I started out handling a lot of the transactions for clients, people wanting to invest their IRA into various types of assets, and help them process that paperwork in order to make the investments, in order to get accounts set up as well. Since that time, I've spent most of my time here at Advanta, the last couple of years, teaching a lot of classes and helping really develop the business side of Advanta, helping to inform more people, more professionals about self-directed IRAs and what's possible when you get your IRA kind of removed from a brokerage account or other type of asset or other type of account most people associate with an IRA account and into different types of alternative assets. Now, one quick disclaimer for Advanta IRA is that we do not provide any legal, tax, or investment advice. We also do not endorse any particular products or any particular investment. Our job at Advanta really is to be the record keeper and administrator for your IRA, making sure things get properly titled, make sure that the income and expenses related to an investment flow in and out of the IRA account itself. But we don't do any legal, tax, or investment advising. Now, during today's webinar and in a lot of the educational programs that we have, we do provide some tax and legal information. So we'll talk about some tax aspects of IRAs or some legal implications, what you may or may not be looking to do with an IRA, but we cannot give you that final determination when it comes to whether you should do something from a tax or from a legal perspective. Now, here's our agenda for today. We'll define really what a self-directed IRA account is. We'll talk a little bit about Advanta and give you more background on what we do here as a company. Then we're going to spend some time talking about the different types of self-directed plans that are out there. With a specific emphasis on some of the 401k type plans, the 403Bs, 457s, thrift savings plans, etc. Talk a little bit more about those and give you a better rundown on those types of plans and how those monies could potentially be used to self-direct as well. We're going to finish the presentation today after talking about the different investment options that are related to real estate by going over a couple of case studies as well and illustrate how somebody who has some money in an IRA account can make a few different real estate related investments with that cash. Now again, if you have questions, if you're listening live today as we go, please type those questions into the chat box on your screen. I'll make sure that I get to them. But first, again, the first item on our agenda today is really defining what a self-directed IRA is. And quite simply, a self-directed IRA is not a special type of IRA. The IRS recognizes the types of IRA accounts as either traditional, Roth, SEP, simple. There's old 401ks, old 403Bs that we're going to discuss in a little bit as well. But self-directed is not a type of IRA that the IRS recognizes, but rather self-directed really refers more to the ability for the IRA owner to take control over the investments in their account and make investments and make decisions based on their own internal desires and what they're wanting to do with their particular account, rather than being kind of boxed into mutual funds or stocks or kind of those more conventional assets. So a self-directed IRA may be a self-directed traditional or a self-directed Roth. And generally speaking, self-directed IRAs can acquire various types of real estate, mortgage and notes, private placements, precious metals, can even invest in foreign currency, participate in futures trading. We've had a few webinars recently talking about investing into cryptocurrency, like Bitcoin and things of that nature. There's a lot of different things you can do. And again, self-directed, that term simply means that you're the one driving that ship and are in control of exactly what you can do. So we get asked a lot of times, why do people choose to self-direct? What is the allure, what is the attraction of a self-directed IRA account? And over the years, I think a lot of our clients have fallen into one or more of the three following kind of boxes when it comes to the reasons behind and the motivations behind opening a self-directed IRA. For one, some of our clients, the self-directed IRA and their retirement funds simply provide them with a new source of capital to invest in assets maybe they already are familiar with. Most common example, especially as we talk about today, someone who invests in real estate, who is familiar with rental properties or rehab, using the cash in their IRA account to buy their next property. So it's for them, for this particular client, this is just simply a different bag of money that they can access, that they don't need permission from a loan officer, they don't need permission from a custodian to do it. They can simply use this money to acquire those different assets. For some clients, then people investing into IRAs and self-directed IRAs, it's a tax consideration. The gains you make within your IRA, if it's a regular IRA account, tax deferred, meaning you're going to not pay any taxes as you invest and reinvest your funds, or potentially could be tax-free if you're dealing with a Roth IRA. So in the terms of your current tax year, whatever you're investing in through your IRA account, that's not going to affect you at all on your personal tax return. So the benefits of using an IRA for an investment, if you're potentially getting large gains within the account, expecting some bigger returns, is the fact that those returns are not going to impact your current tax situation. So allow those gains and those returns to flow back to your IRA account and deal with those tax issues at a later date. Third bucket, again, I think usually has a lot of overlap with the other two as well. And frankly, some people are frustrated, they're scared, they're wary, they're just tired of having all their funds or all their assets tied up in the stock market. As of this webinar recording, the stock market's been hitting all-time highs over the last few months. And I think a lot of people realize that at some point there is going to be a correction to that market, and they don't want to be caught on the wrong end as they may have been in years past, especially back in 2007, 2008, with the last great recession that we had. So for individuals who have a lot of their money tied up in the market, putting those funds into alternative assets, whether it's real estate, notes, private placements, et cetera, allows them at least to hedge their bets, put their money again into assets that they can control, things that they are in charge of, and get some of it at least out of that stock market. So a little bit about Advanta IRA as a self-directed administrator. We have over a combined 20 years in the industry. The funds that individuals deposit with us are secure. All of the cash in an IRA account up to $250,000 is insured through FDIC, so we protect the cash there. We currently have actually this slide's a little outdated, we actually have over $800 million in assets under management for all of our clients and across our two offices. We maintain physical location both in Atlanta and Tampa. Our Tampa is our corporate office. And what's important, I think, to a lot of our clients is we have an account manager system for handling all of our new accounts and all of our current accounts, and that each individual who signs up with a manager and becomes a client gets appointed to one specific person in our office to help them with all matters relating to their account, whether it's making a new investment, getting bills paid, just general questions on their account. That concierge system we found to be quite popular with our clients, as it gives them just simply one point of contact. It's not calling an 800 number, not hoping to get the next available person in a phone call queue system. And as such, in addition to that account manager system, we also believe in providing our clients with a lot of educational material. This webinar is but one of several that we do throughout the year and even throughout the month. We do live events at our office in Georgia, in Tampa. We also do these webinars for people who can't make it, or maybe who don't live close to one of those particular offices. But we want people to be informed. We want people to be educated about what it is that they're investing their funds into. A lot of times the webinars we have and the seminars we have, we bring in guest speakers who are experts in their field to help discuss a couple other topics outside. Now, today's webinar is pretty much just the self-directed IRA, so it's just me today on the particular webinar. But if you'd like to look and find those other classes we've had or look for other additional resources, we have a YouTube page. We have some on-demand videos on our website. And we also have a blog to get the latest and more up-to-date information about self-directed IRAs. Again, really just becoming educated and knowledgeable about what you're looking to do with a self-directed IRA account. So we're going to talk a little bit now about the types of plans and go into a little bit more detail sometimes than we usually do when it comes to employer plans. Employer plans are where a lot of individuals have their retirement funds. You've worked for a company, you've worked for an institution, built up a large retirement plan, and all you know is there's some acronym or some number related to your account. Not really sure what that is. Hopefully we can cover some of that here in just a moment. But as far as funds and assets that can be self-directed, again, self-directed, as I said a few minutes ago, is not a special type of IRA. Self-directed refers to your ability of what you're investing into. So at its core, a self-directed IRA is either a traditional IRA or a Roth IRA account or a simple or a SEP IRA account. Okay, the differences between some of these accounts, just very quickly, traditional SEPs and simples are all tax-deferred accounts, meaning that your contributions go in, there's tax deductions that you get up front for making your contribution. The money grows tax-deferred. You don't pay tax each step of the way. But when you get to retirement age, with a traditional, a SEP, a simple, and even the 401ks and the employer plans, you will pay tax at that time, and hopefully you're in a lower tax bracket at that point in your life. The Roth IRA is the one account that stands on its own. The Roth IRA works kind of the reverse of the traditional and SEPs and simples. Your contributions into a Roth are not tax deductible. So you forego that initial tax deduction for contributing to a Roth, but going forward your money is going to grow tax deferred and ultimately be tax free to you in retirement. So you're paying taxes up front on that money when you make the contribution, and you're not getting a deduction, but you have the huge benefit that all of your gains, all of your returns, all of the growth within that Roth IRA is ultimately going to come back to you completely tax-free. So again, the different IRAs that are listed here, the traditional, the Roth, the SEP, and the simple, any IRA custodian can generally handle those types of accounts. So SEPs and simples are great for small business owners, but any account or any custodian can handle those types of an account. It's ultimately what you're going to invest in that differentiates the self-directed IRA from maybe a more conventional brokerage IRA account. So again, self-directed is not the type of IRA, it's simply explaining the different investment options. Now, in addition to the IRAs, you could also self-direct an individual K plan, basically a solo 401k plan we're going to talk about here in just a moment, in a little more detail. And also you can self-direct any former employer's plan. So if you worked for a former employer who you obviously no longer working for, and you had your own retirement plan there, you made your own contributions, maybe that institution did some profit sharing matches or some other matching contributions to the plan. As long as you're no longer working for that company or that institution, you can roll money out of those employer plans into a traditional IRA with no tax consequence, and then in turn self-direct. Now, the one restriction on employer plans, unfortunately, is if you are working for an employer, so you have, say, a 401k or a 403b through your current employer, they may restrict your ability to move money out of that plan. You may have to meet certain qualifications before you would be eligible for a rollover. Once you're no longer employed, there is no restriction on moving that money. So when we talk about employer-sponsored plans, again, I mentioned a lot of times there's some acronyms, there's some numbers that people refer to when they talk about employer plans. I think it's a good idea sometimes is to take a step back and make sure we define exactly what those are. And when you talk about employer-sponsored plans, they generally fall into one of two categories. There are defined contribution plans, and there are defined benefit plans. Defined benefit plans are plans in which a company or an institution, again, agrees to provide you with a guaranteed benefit or guaranteed payout when you reach certain ages in retirement. For instance, you could work for a company that offers you a defined benefit plan where at age 65 and you're retired, they will pay you, just using numbers, let's say they'll pay you $500 a month as a defined benefit. The company then that has agreed to pay you that particular pension or defined benefit is then on the hook for making sure that the funds are there, that they are making proper investments now. Say, let's say you're age 40 you're not going to get that benefit till 65. Well, your company needs to start putting money away now to make sure that when you do turn 65, they will be able to afford to make that certain payout. Now, these types of defined benefit plans were very popular back in the 50s and 60s and even into a little bit into the 70s. At that time, more employers were realizing they were on the hook for these investments. Congress created more of a defined contribution plan, which today a lot of people just lump into one number and say, hey, it's my 401k. Now, 401k and its other associated ones we'll talk about here in a minute are defined contribution plans. I mean, if you work for a company, they will tell you up front, here's how much we are going to put into the account. It is up to you to ultimately grow the account. And typically with deferred contribution plans, you have the ability to make your own contribution of your own salary, have your employer typically do a match on top of that if they do offer that. So defined contribution, defined benefits are generally the two types of plans that you will see. There are still certainly some defined benefit plans that are still in existence. But as far as the different acronyms and the kind of alphanumeric descriptions, the 401k, again, most people are familiar with that term. It's a defined contribution plan that is put in place by a private employer. Your Coca-Colas, your IBM, Microsoft, et cetera, have 401k plans where their employees defer part of their salary, and the company either does some kind of percentage match or some profit-sharing match on top of that. And again, 401ks for private employers, there are 403b plans that, generally speaking, are defined contribution plans for public education employees. They work a lot like the 401k plan does. It just is a specific type of plan that exists for public education employees, some nonprofits, some hospitals as well. So at Advanta, we've seen a lot of 403bs over the year for former teachers or former educators who've maintained those types of plans. 457, this is simply the deferred compensation or deferred contribution plan for government employees, your state and local governments, your cities, counties, et cetera. They offer 457 plans for their employees. Again, still a deferred contribution plan. And then you have TSPs, or thrift savings plans, that are deferred contribution plans for U.S. civil servants, the post office employees, et cetera, and members of the military. So the 401k, the 403b, the 457, and the TSP plans, again, are all basically defined contribution plans, where the company or the institution is letting you say how much up front you're going to put into the plan. They may or may not do a match, but they are not guaranteeing you any benefit at the end of the road. It's up to you to invest that money as long as it's within those particular plans. The last type of plan, again, is the defined benefit. I mentioned that at the beginning of this slide. Defined benefits usually take the form of a pension. Okay, so it could be a public institution, could be a private institution, where individual, again, is going to be guaranteed in retirement a certain dollar amount per month or per year as a benefit, and it's up to that institution to make sure that that defined benefit plan is properly funded over the years so that when the individuals they have reaching these ages, there is money within the plans to pay those. Sometimes defined benefit plans make the news for certain government employees in certain states. If they're running short on funding problems, you'll hear them talk about, is that plan underfunded? Meaning basically there is not enough contributions in that plan, not enough money growing to satisfy the obligations that will be due. So these are the different types of employer-sponsored plans. And again, as long as you're a former employer and you have one of these plans, there's no issue at all with you rolling that money into an IRA account. And again, as we'll talk about today, a self-directed IRA. If it's a current employer, again, sometimes you have to meet a certain age requirement or have been with the company a certain amount of time before you're able to move that money out. Now, we do have three different types of employer plan accounts that we hold here at Advanta IRA. Now, one of them, our full service model, we call an individual 401k plan. It's basically a safe harbor 401k plan that is especially suited for sole proprietors or self-employed individuals who own their own business and who do not have any common law employees who would otherwise qualify under the plan. If you have a business where you have employees who have worked with you for at least a year, or they're full-time, they're greater than part-time employees, then you have to have them included in the plan and therefore have to have different types of discrimination testing done, different types of reporting done that generally is going to lead to a little bit higher annual cost to run. But if you own your own business and you don't have those employees that would qualify, the IRS allows for a streamlined 401k plan where you get the benefits of doing your own salary deferral, doing your own profit sharing matches, where you can actually contribute up to $60,000 a year into your own solo 401k plan, far greater than the $5,500 or $6,500 that you could contribute each year into a simple traditional or Roth IRA account. So the Individual K, again, a great plan for sole proprietors and self-employed individuals. And under our Individual K full service model, we will provide you with that IRS approved plan. Okay, the IRS requires you to have an approved plan and plan documents. We will allow you to lease that plan. And we will also provide the record-keeping services. So you can make your contributions to us. We will then purchase the assets and take in the income, pay all the bills at your direction as we do with our IRA accounts. Now we also have, for someone who wants a little bit more control over their own 401k, we have what we call a do-it-yourself or do-your-own 401k plan. Basically, it's the same 401k plan that we have that we give in our full-service model, but simply in this case, the individual only leases the plan document from us. So they use our plan documents, they obtain a tax ID number for that particular plan, and in general, the IRA or the 401k plan owner, as also the trustee, will now perform the record-keeping duties. They will get the tax ID number for the 401k plan and open up a bank account in the name of their own 401k. And this allows you to simply make contributions into that bank account, make your investments directly through that bank account, and keep track of your own records and your own income and expenses, et cetera. So it gives you greater autonomy to really do that control. That's why it's called a do-it-yourself or do your own. You are going to simply use our plan documents so that you're kind of legal and legit with the IRS, but it's up to you at that point to then do your own reporting and do your own record keeping. Lastly, the other model that we offer at Advanta is we call a record keeping plan. This is especially suited for individuals who already have a 401k. They have a profit sharing plan. They might have a cash balance or a pension plan that is already being administered by a TPA or a third-party administrator. So somebody has already provided that plan document for that individual, but they would like to use some of the cash, some of the assets in that particular plan to self-direct. And so an individual can open a sub-account, basically of their larger 401k with Advanta, move some cash or assets to us, and then purchase the alternative assets. So again, a common record-keeping plan might be a doctor or a lawyer or some other CPA or professional that has their own 401k profit sharing or defined benefit plan for their company. Maybe they have a couple of employees, but that plan is then typically held with they have the TPA and they have all their assets held with a Vanguard. They have them held with a Schwab. They'd like to move some of that cash out to do some investing. They don't need us to provide a 401k plan because they have that, but we can provide the record-keeping service that the Schwab or Vanguard won't, and ultimately report back to the TPA at the end of the year, who does the annual reporting for the 401k plan or the plan itself. Now, moving money between accounts is often a question that we get, especially for someone looking to start an account here at Advanta IRA, is what is that process? Is there going to be a tax consequence? I need to make sure I do it right. The first way of moving funds between retirement accounts is called a transfer. That's when you move funds directly from one IRA account to another. So you have an IRA account at Schwab or Fidelity. You have an account at Advanta. The money goes directly from that brokerage account to Advanta. The money does not touch your hands. Therefore, it's a non-taxable and non-reportable event for you to move money between that account. Because it's non-reportable and non-taxable, you can move funds as often and whenever you'd like between your various IRA accounts. It also allows you to do partial transfers. You do not have to move all of the money from one account to the other. You can move money only as you need it between your IRAs. The only requirement is that you do paperwork each time to move money back and forth. So typically transfers are done from IRA to IRA, traditional to traditional, Roth to Roth. Now, the other method of moving funds within retirement accounts is referred to as a direct rollover. Individuals who have money in those 401k, the 403b plans, what we talked about a few minutes ago, when you're no longer working with the company or you're able to do a rollover, this is, again, a different terminology. The money goes directly from one of those employer-sponsored plans into an IRA account, again, without you touching the funds. Because the money does not go into your account and touch your own hands, it's also a non-taxable event. Now, there is a little bit of reporting that gets taken care of by the resigning administrator as well as Advanta in receiving the funds, but it is non-taxable. As long as you don't touch the money coming directly from that employer plan into Advanta, non-taxable. And if you have multiple employer plans that are out there, you can do multiple direct rollovers in a given year. All right, the next item on our agenda is to talk a little bit now more so about the investment options. And again, today's webinar is on real estate within an IRA or real estate within a 401k plan. So we're focused primarily again today on those types of assets. Now again, with a self-directed IRA account, you have the option to put your money into these assets and either call up your brokerage account, call up your local bank where your IRA is sitting in a CD, and ask them about buying rental properties or ask them about buying tax liens or ask them about buying mortgage notes. They're not going to allow you to do it or say it's something you can't do because, again, it doesn't fit within these assets that they offer. The IRS does not require every custodian to hold every possible asset. So the IRS has rules that say you can invest in all these different types of assets, but you have to have a custodian who's willing to hold that asset that you want to invest. Each custodian can decide, again, what they want to hold. That's why a bank may only hold CDs in money markets, or a brokerage firm only allows for the purchase of the mutual funds that they offer. But the types of assets that we see in a self-directed IRA, again, are very diverse, and a lot of them do fall into the real estate category. Probably 70 to 75% of the assets that we hold at Advanta are in the real estate realm. Individuals investing into the physical property, either as a commercial or residential rental property, could be short-term rentals, the seaside, mountain vacation rentals, could be a longer-term, single-family home that you're doing a 12-month lease on. We also have individuals invest in rehabs or flips, individuals wanting to purchase a house, get it fixed up, and get it sold and make a profit, can do so and have that profit coming back into their IRA without any tax consequence. Individuals invest in raw land. There are private real estate investment trusts. You can purchase condos, mobile homes, duplexes. Again, and then those are those first examples I just went over. That's all without you're buying. Your IRA is almost buying the hard asset. You're buying the physical structure, the brick and mortar, the dirt of that real estate investment. But we see individuals also invest in a lot of other assets that are tied to real estate, even though it's not buying the actual property itself. Your IRA can invest in tax liens, invest in mortgage notes, be a private lender. You can buy a real estate contract and assign it out of the account. So there's a lot of different things that are possible with real estate. And I mentioned a little while ago, you can also buy various types of private stock and precious metals and so on. There's just so many different things you can do with a self-directed IRA. It's usually a good idea to kind of narrow that down in your own mind, really what you're most interested in. But the opportunities really are endless. In fact, the IRS says the only things you can't do within an IRA account, the only investments you can't buy, are either life insurance or collectibles. Your collectibles would include your antiques, your alcohol, your stamps, coins, etc. within the particular account. Okay, now there are some coins, if it's a gold or silver eagle, gold and silver, Canadian maple leaf, but the value of the coin is basically the value of what gold or silver is trading on. Those are permissible within an IRA account. So the rare coins that are not allowed within an IRA. So again, the IRS says we're not going to list all of the possible investments you can make within an IRA. We're simply going to list all the things you can't do. And the things you can't do, you can't buy life insurance and you can't buy collectibles. And there are certain disqualified persons who cannot receive any benefit from your IRA investment or should not be transacting with your IRA, basically buying and selling between them. We'll have some examples here in just a moment of what some transactions with a disqualified person might look like. But it's important, of course, to define who is a disqualified person. The IRA owner and their spouse are considered disqualified. And before we go a little further, let me iterate. The IRA is its own legal entity. It is separate from you. The IRS views it as its own entity. So for that IRA entity, you personally are a disqualified person. Again, your spouse, your parents and grandparents, your children and grandchildren, as well as your spouses of your children and grandchildren. So your daughter-in-laws and son-in-laws are also disqualified people. And they include any business or entity that is owned or controlled by one of the above parties also. Okay, so we talk about doing a prohibited transaction. Some examples: you can't lend money, for instance, to your daughter. That doesn't mean you can lend money to her business, okay, because her business is owned by her as a disqualified person. The IRS did think about a few of those kind of things down the road to include those particular disqualified persons. Now, what are some examples of what we're talking about? A prohibited transaction for an IRA is one in which involves a disqualified person. What are some examples of those types of transactions? Well, if your IRA, again as its own entity, wants to buy a property from your son is a disqualified person, that's a prohibited transaction. If your IRA buys property from a third party but you want to lease it to your daughter is a disqualified person. It's prohibited. Your father's IRA, keep going down the list here, your father's IRA wants to lend money to you or your son. For your father's IRA account, you and your son are the lineal descendants and therefore disqualified. Your IRA buys property, needs to be fixed up, so you hire your son or you want to hire his company to perform the rehab work. Again, they are disqualified persons. Now, those first four examples, you have the IRA on one side of a deal and a disqualified person on the other. Your IRA is a buyer of real estate, your son is a seller. Your IRA is the landlord, your daughter is a tenant. Your father's IRA is the lender, you or your son are the borrower. All of those examples are ones in which the IRA is on the opposite side of the particular deal. Buyer, seller, landlord, tenant, borrower, lender. So that's what ends up constituting a disqualified particular investment. Now going to the kind of last example there, what if your spouse's IRA, spouse is a disqualified person, if they own a piece of real estate already within their account, within their IRA, they cannot sell you a portion because you and your IRA account are disqualified from buying a partial interest in that property from your spouse's IRA. But this is a fine point to understand, but it is allowed. If your spouse, when they went to buy this property at the outset using their IRA account, decided at the very outset of the transaction that they would like to partner and own this property with your IRA on a kind of a co-ownership basis or tenants in common, that is possible to do. So if before the spouse's IRA had actually purchased the property, you identified with the seller, who was a third party, that both your IRA and your spouse's IRA were each going to buy property owned as a percentage basis, that is possible to do if you do it at the very outset. Because in that instance, your spouse's IRA is not selling to your IRA, but rather both of your IRAs are buyers, both on the same side of the transaction, doing business with a third party. So this is a little bit of a fine point, but we have seen a number of individuals over the years do that, not only just husband and wife doing it as kind of a tenant in common arrangement, but also brothers and sisters lending money, buying property, combining funds. We've seen individuals use their IRA to be one of 10 different members in a particular LLC. So there's a lot of different things certainly that are possible with partnering. You just have to make sure when you structure the transaction, a disqualified person is not on the other side of that particular deal. So I want to kind of wrap up the last part of this presentation. I was going over some case studies, and instead of, a lot of times we do with a case study is go through a bunch of different examples, a bunch of different individuals. Today's case study, we're going to talk about just one particular individual who has money in their IRA account. What are some different things that they could do in structuring their particular real estate purchase? Now, for someone who's looking to get started with Advanta, the process is very simple. Opening up an account, filling out our account application documents. One of the documents in there is typically a transfer or a rollover form to get the funds moved from your current custodian over to a new Advanta account. So we help you get the account set up at the beginning, get the funds transferred over, and ultimately then start investing. You as the IRA owner telling us then what it is that you want to invest in, so we can work with you, work with other parties to make sure that investment gets properly titled, make sure all the documents are properly titled, make sure you've approved of them as well. So keeping that in mind, we're going to go into our case study and talk about John. Now, John has a traditional IRA account, $100,000. He's interested in real estate. But he's interested in really real estate as a concept. He knows there's a bunch of different ways you could invest within real estate. You could buy rentals. You could potentially lend money to friends. You could buy tax liens. You could buy auction property. A lot of different things, again, you could do within your IRA. So he has the money in his brokerage account. So he opens up the particular account with Advanta, transfers $100,000 over from the brokerage account, and then ultimately knows that when he makes this investment, the income that is generated will flow back to his IRA, and any expenses related to the property must be paid out of the IRA account, and then Advanta will act as the administrator for the account, keeping track, receiving and depositing the funds, and paying the bills at his direction. So what are the couple of different things he could do? How would the different investments look based on what it is that John is looking at buying? As we go through the presentation here, this last portion, if you have any questions, please make sure you type them into the chat box on the screen. All right, so John initially decides, I'm going to buy a piece of real estate. How does that work? Well, the property needs to be, again, purchased in the name of his IRA account. So we will work with John up front. We've gotten his account established. We've gotten funds transferred over. When he goes to write the contract for the purchase of this real estate, the contract, the buyer's name will be Advanta IRA for benefit of John Smith's IRA and his account number. This demonstrates to the IRS that this is an asset owned within his IRA under the IRA umbrella. It's not a taxable event for him to take money from his IRA to buy it, because this is an asset that the IRA itself is purchasing. Now, all of the funds would come from the IRA account. In this example, again, as we talked about a minute, you can partner on purchase with yourself and others, whether it's a spouse or a friend, their IRAs, their personal funds. He could do that as well. If he's looking at buying something that's going to exceed the $100,000 in his particular IRA. And again, all of the income, the rental proceeds, the sale, when he sells the property, any equity, any profits made, are all going to come back into the IRA tax-free. Now, there's no tax due to the IRA on those sales, or no tax due to the IRA on all the rental income that's received each year. Only when John gets to retirement age and starts taking his distributions from the account is he going to have any particular tax ramification. Now, again, our job at Advanta is to assist in that process from contract to closing to keep this account tax protected. We're going to make sure everything gets titled correctly, make sure the funds are flowing the proper way, so that John's gains are all going to come back into his account tax-free. So in purchasing this property, John's role is to identify the property that he wants to buy and figure out what offer he wants to make, and make that offer in the name of the IRA. Ultimately, the offer gets accepted, the deal gets funded, and closed within his particular IRA account. So again, our job at Advanta will be to work with the title company, the attorney handling the closing, making sure everything gets titled in the name of his IRA, make sure John approves of it, and then going forward, receive the income, their tenants, make their rent check back to the IRA, and pay expenses right on back to the IRA account. The IRA will pay the expenses as well that are due. So in this particular strategy, John receives net rents of $1,000 a month for 4 years. Total $48,000 back to his IRA account. He sells the property in year 5 for $150,000. So he had some appreciation during that 5-year period. He's got $50,000 of profit on the upside. And obviously these numbers are all just raw numbers, not factoring in some other considerations. But ultimately, all the money that comes back to his IRA account comes back without any tax implications. There's no capital gains, there's no income tax that's going to limit that investment. The only thing he's going to have going out are commissions or whatever maybe on the real estate sale and other types of expenses. All that money now comes back in, and he has that money sitting in his IRA account. So this is an example, again, of buying a rental property. Now, before we go on to the next case study, I have a number of questions come in. I would encourage people to keep asking those. A couple of questions came in we're going to talk about here in just a moment. So I'm going to hold off on a few of them regarding the checkbook LLC because we're going to talk about that here in just after this next case study. One question said, can funds or cash from the funds in an IRA be used for real estate education? I think that individual looking, can you use funds in your IRA to pay for attending real estate seminars, weekend seminars, etc.? Our reading of the rules would say no, because that education is for you personally. And so if you're taking IRA cash to pay for your own personal education, whether it be a university education or a real estate education, that is a distribution out of the IRA. So you can use the funds in the sense of taking a taxable distribution and using the cash to pay, but as far as keeping it as a valid IRA expense and not be taxable, we do not see that as an option. Talking about the LLC, and I'll say just in general for this question, can you make an investment basically funded by money from a solo K and then also traditional or Roth IRA accounts? And the answer is yes. Again, when we talk about the partnering, I mentioned a husband and a wife buying property together as partners, being spouses. It can also simply be you have two different types of IRAs. You have a traditional, you have a Roth. You can use that along with, again, maybe even with the solo K, to buy real estate on a percentage basis. Again, you have to keep the percentages static, and you'll split the income and expenses proportionally, but you can fund an investment, whether it's a piece of real estate or an LLC, out of both accounts. So again, can you buy a property and partner two different IRAs under the same name? Again, one traditional and one Roth. Again, the short answer to your question is yes, although you would maintain two separate IRA accounts. You would have to have your traditional and Roth kept separate unless you wanted to do a taxable conversion, which is a different discussion. But if you have these two different accounts, you can partner them. You can buy the same property. You'll just have one IRA owning a certain percentage and the other IRA owning a percentage and splitting the income and expenses then proportionally between the two. Another great question. What is the tax situation when an individual of an IRA turns 70 and a half? Now, with any non-Roth account, so you have a traditional SEPs and 401k accounts, when you turn age 70 and a half, within those particular accounts, the IRS requires that you take a mandatory distribution. It's called a required minimum distribution, or an RMD. Now, at 70 and a half, the IRS, you figure out your value of your RMD based on the IRS life expectancy table. It usually ends up being about 3 to 4% of your total value of all of your taxable IRAs you must take as a distribution. You can satisfy that distribution with cash in your account or with assets. And you do not have to take money out of each IRA. So if I have an IRA at Advanta invested in real estate, and it has a little bit of cash, but I also have a brokerage IRA, and I have cash in that account, I will use the combined values of those two accounts to determine what my required distribution is. But I can then satisfy that distribution from either or both of those accounts. So if I have a $100,000 account at Advanta, a $100,000 account at a brokerage firm, and my RMD for the year is $15,000, I can simply take $15,000 out of my brokerage account and leave my Advanta IRA alone. So it's typically how we've seen people handle their RMDs at 70 and a half. And when you take money out at 70 and a half, within those types of IRAs, it is included in your income tax. Another question, if in the last example we discussed here at the rehab house, if John, can he fix up the property himself? And the answer to that is he cannot. But it says if he does it anyway, what are the penalties? Well, if the IRS says that you engage in, and finds that you've engaged in a prohibited transaction, which, John doing the work himself on a property would be considered prohibited, his IRA would cease to be an IRA the year that activity took place. So say John buys this property in 2017, He starts doing the work on it. He rehabs it. He sells the property next year or in 2019. The IRS catches wind that he did indeed do the work personally, which was prohibited. They will go back and make him distribute his IRA as of the year that activity first took place. So 2017, John would have to declare a full distribution of what was involved in that IRA account and pay any back taxes and back penalties for non-payment. So the IRS expects if you do something prohibited that you declare it that tax year, and if you don't, they will levy penalties and fees and taxes. It can actually end up eating up the entire amount of your IRA account. So that's kind of a very severe penalty if they find out. Another great question, we'll kind of keep them coming. We'll keep moving forward in just a moment. But in the case that I roll over a traditional and a Roth and the self-directed IRA, do I still pay one yearly fee of $295, or is it two accounts and pay extra fees? The answer to that question is you would have two fees because we would have two accounts. The $295 that we charge a year to manage a property, if you have two different accounts and we get one rent check in, we have to do actually double the work to split that rent check between the two accounts. Or if we are cutting a check to pay a bill, we have to pull money out of each account. So that's actually double the entries. So it is double the annual fee. Now, there might be some other fees, the account setup fees, the transaction fees we can certainly work with you on to not have it double up. But the annual fee, that is the case. Do you have to have receipts for work done on a rehab home? You have to show them. In order to get a bill paid at Advanta, you do fax us the invoice, and then we get a check cut out of the account and then paid to your third-party vendor. So currently we do ask you to send us those receipts, those invoices basically, for the work done. Another last question here before we move on. Can an IRA owner be involved in managing a rehab or a rental? And the question right after that, what actions can John perform on this? Well, the way Advanta interprets the rules of what you can and can't do, we read that you should not be doing any of the physical work on the particular property. So if there's maintenance to be done, swinging the hammer, painting the walls, etc., your IRA should be paying third parties to do it. You also should not be compensated for anything that happens within the IRA. So if you're a realtor and you want to list the property, or be the listing agent, or be the buyer's agent, our opinion, you should not take any type of commission for that work. Now, you may kind of obviously look to find the property, you know how to draft the contract, but you should not receive a commission. Likewise, with the rentals, you would arrange for your tenant. You can select who your tenant would be, but have your tenant make their rent check payable directly back to Advanta. You shouldn't be in that physical possession if the property is in the IRA. But you can select your tenants. You can select the work to be done. You can look at the property and say it needs a new roof. I'd like to paint the house green. But again, our interpretation, your IRA then needs to pay those third parties to do the actual work. So in a sense, you can manage it in one sense of the word. You're overseeing the activity. You're directing the activity. You tell your tenant to send the rent check here. There's an invoice to be paid, by a particular, from a vendor. You hire the vendor, then direct Advanta to pay them out of the account. So I hope that answers that question. If you have further questions on those, please do reach out to me on an individual basis. Now, our next case study. So that was John. And again, great questions, and keep them coming. We certainly have some time for more. That was John buying a particular rental property within his IRA. That was his real estate investment. As I mentioned, John could also look to invest into different types of loans. His IRA doesn't have to own a property to be involved in real estate. He could actually lend money from his IRA account. Could be a simple mortgage, could be a wrap loan, could be an unsecured loan, could be a joint venture, kind of what his underlying purpose is with who his particular borrower is. And when you make a loan out of your IRA account, the terms that go into making a note or a mortgage, the interest rate, the amount that's being lent, the maturity dates, et cetera, those kind of terms are all under your control as the IRA owner and basically as the private lender. Your IRA is being the bank in that particular transaction. So if you go into a bank today and ask for a loan, the bank dictates the terms in which they will lend you money and how much they will lend you money based on the collateral that you put up. So if somebody's borrowing money from your IRA, your IRA is sitting in that very same position. So in this particular case study, we have John's IRA going to act as a lender. He knows Sam, the friend of his, fellow investor, who rehabs houses. Sam always needs cash to make the buy the properties, get them fixed up. Sam finds a house he can get for $70,000, kind of a dilapidated house, but with $30,000 of work, get that property ready to go and sell it. So John offers to lend Sam the $100,000 from his IRA, buy the house, get it fixed up, and the loan gets secured by a first mortgage. So Sam is going to sign a note and sign a mortgage back to John's IRA, promising to pay him the $100,000. And the terms of any other terms of note, the interest rate, et cetera, as you can see on the right-hand side, are going to be negotiated basically between Sam and John. So John's IRA does have a first lien against the property in the form of a mortgage. So Sam gets the loan. The benefits to Sam as the rehabber, doesn't have to go to a bank, no down payment, at least in this instance when working with John. Certainly John could have asked for one. So Sam, it's very advantageous for Sam to borrow from John's IRA and just kind of get around all the red tape that a bank might throw up. The terms, 5% interest and a third of profits. So that's what John and Sam agree on, that Sam is going to pay him at least 5% interest on the funds, for $5,000 roughly or per year, and they're going to split the profits on a 33% basis. So Sam's going to get the majority of the profits, but the rest of the profits will go back into John's IRA account. So when they sell the property, they make $60,000 in profits. $20,000 of that will go back into Sam's IRA account. So he ends up making a good deal of money back into his IRA. Doesn't have to do the work on the property, doesn't have to deal with tenants, doesn't have to deal with contractors, etc. He can simply lend the money out to somebody else, agree on a repayment plan, whether it's a flat interest rate. He could have simply charged Sam 10%. In this case, does a particular loan, does with some profit sale. And again, Sam still makes money on the deal. Didn't have to deal with a bank and didn't even have to put up any of his own money. Question came up, can the profit cut be included in the note securing the mortgage? The answer is yes, and it should be. It should be listed in the note exactly what the repayment terms are going to be. In this case, again, the note would have probably said something like Sam promises to pay $100,000, and Sam will pay at least 5% interest and also pay 1/3 of any profits over and above the $100,000 back to the IRA account. That would be the satisfaction, essentially, of that note and mortgage. All right, the last way John could invest in real estate, or at least another, I would say the last way, but just another way he could invest in real estate, and something was the questions were asked about earlier about checkbook control for an IRA or for a 401k plan. Now, checkbook control within the industry is typically achieved when an IRA account forms an entity, so in most cases it's an LLC, in which the IRA owns 100% of that entity, and the IRA owner, or some other physical person, is in control of the entity itself. So you set up for instance, set up an LLC. The IRA is named as the sole member. The IRA owner, in this case John, is named as the manager of that particular LLC. By doing this type of an investment, John's going to have his IRA not fund individual purchases or individual loans, but rather when he sets up this entity, have the IRA capitalize the entity by having Advanta send the $100,000 from his IRA into a bank account that he's established for this particular LLC. Cash is now in an LLC bank account. John, as manager, can write checks, pay bills, certainly make investments directly in and out of that LLC account. That's why it's called checkbook control, because John is no longer coming back to Advanta each time he needs a check, anytime he needs to pay a bill, anytime he gets funds back in. He has that degree of control over the account. It's something you will definitely want to make sure that you understand fully going in and understand the rules involved. We talked about earlier things kind of you can and can't do, but it is the way individuals have gained a lot more control, particularly over the funds in his account. How does this work? Well, John wants to buy properties at auctions or tax liens. and it can be difficult. We're very good at Advanta at getting checks issued out of an account within a day or so at the most of request. But for a tax lien or an auction purchase, the property or the purchase might need to be done right then and there. Creating this type of LLC with the checkbook control is going to give John that immediate cash to the funds. So the cash is going to be moved from the IRA into the LLC, allows him to make his purchases quicker. So kind of how does it work? John forms Savvy RIA Investor LLC for his IRA, names himself as manager of the LLC. So he files the articles for that LLC with the state of Florida or Georgia, whatever state he's in. That's the name of the LLC, and he will list himself as manager. He will then direct Advanta to send $100,000 from the IRA into his particular LLC bank account. So as manager of the LLC, he will open the bank account, get a tax ID number, and ultimately the funds from the IRA go into that particular structure, and he can disperse the funds and then again to purchase those auctions, properties, purchase those tax liens, all in the name of the LLC itself. The income generated from those investments goes back into the LLC bank account. John pays all the expenses out in his position as manager, so John is now doing all the record keeping. That being said, again, this type of structure is something that John wants to make sure he's got a firm understanding of what he can and can't do as far as doing things that are prohibited, investing into prohibited assets. Make sure he keeps good records. Somebody asked a question earlier today about keeping receipts. John's going to need to make sure he keeps receipts and can document all the money in and all the money out going out of the particular LLC account. And so kind of what's the difference? John buys a property with an IRA directly or buying it through the checkbook control. Well, if he buys it through the IRA administrator, in this case, us here at Advanta, we're going to keep all the records. The IRA owner is going to have an arm's length transaction from the funds. We will receive the income and pay the bills, and we're going to have a clear record of all activity taking place in that account. We will have kept all copies of the invoices, the receipts, the rent checks that have gone in and out of that IRA account. It also makes John less likely to engage in a prohibited transaction. If he doesn't have the ability to just write a check on a whim, he's going to have to ask Advanta for it, and hopefully we can catch anything he might be doing to be prohibited, or at least he's going to ask us for that. The IRA owner also, though, would have to submit forms for checks and for investments. He'd have to tell us what he's investing in, go through that paperwork. He'd have to submit the invoice to us, as I mentioned earlier as well, to pay those bills. The checkbook IRA gives him, obviously, though, if he goes that route, is the freedom, greater control over the accounts. He's going to have reduced fees from Advanta. If you're not having us do all the record keeping for 2 or 3 different assets, you're only going to pay us 1 fee a year for that one LLC. But with that LLC comes the greater responsibility to keep the accurate records. And again, it can be easy to make a mistake or do something prohibited when he has a checkbook. We have seen a few clients over the years do something inadvertently. It wasn't an intentional prohibited transaction, but it was prohibited nonetheless. It was made easier because they had access to those funds. But again, the checkbook IRA does give you quicker access to funds if you're looking to buy an auction property, looking to buy a tax lien. And frankly, for a lot of clients who just simply want more control, the checkbook LLC gives that to you. Now, before we close today, I want to go back over a couple of questions we had. Someone asked, can I set up a checkbook LLC for my solo 401k? The answer is certainly yes. Any type of IRA, Roth IRA, solo 401k fund can set up a checkbook LLC and be the owner of it. Let me go back through our other questions here. Can a checkbook LLC be used to purchase property and make mortgage loans? As we just talked about, yes. The LLC is subject to the same rules, same investment possibilities, and same restrictions that we talked about as well. The only difference when you use the checkbook control is that the LLC's name is going to be on the title, not the individual IRA account. Another questions we had coming in. If legal issues happen and John has no money in his IRA to pay lawyers to fight Sam, if I guess I'm assuming something happens in that borrower situation, can he use non-IRA money to pay lawyers? That's a legal determination. Best case scenario, your IRA would pay your attorney or should pay your attorney. That being said, if your IRA had no cash, you didn't have any way to get more money into the IRA, meaning you couldn't transfer additional funds or roll over or make a contribution, that'd be something you'd have to discuss with your attorney at that particular time. That's kind of, again, an individual situation. Not trying to duck the question. It's just obviously when that happens, you need an attorney, but you don't have anything in the IRA to pay for it. You might have to find just a different way about doing it, maybe getting a loan from somebody else, or seeing if your attorney thinks that would be an issue for you to simply pay it personally. Do we offer pre-constructed note terms that are legally compliant? We do not. Again, kind of as I mentioned at the very beginning of the presentation, we do not get involved in doing any legal work. My background, if you notice in one of the earlier slides, I am a licensed attorney. I don't do any legal work or do any legal review for Advanta clients. So the notes or mortgages that were provided to us, our job is to make sure they're titled correctly and make sure the clients have approved of them before we ultimately make that particular investment. So as far as whether or not they're legally compliant from an interest rate and term standpoint, that is up to you. You can always use a private mortgage broker as well to use that. I am a partner individually with an LLC on a rental property. May I hire that LLC to manage another piece of property held in my IRA? I would say probably not. Now, if you are a very small partner, where you were only, say, less than 10% owner in that particular LLC, and all the other 90% were owned by non-disqualified persons, you might have a case there to do it. But if you're a partner greater than 10% interest, it's likely going to be prohibited for you to have your IRA hire basically the LLC to run, because you are not supposed to get any personal compensation or benefit from what's going on in your IRA. You would not be allowed to hire yourself, and hiring an entity in which you have an ownership in, even if it's a less than minority share, if it's somewhat significant, would be prohibited as well. Does Advanta have a minimum amount in checkbook IRA account? No, we do not. It's completely up to you and how much you want to put into your IRA and ultimately put into the LLC. We have our administrative fees for a year. They're from $195 to $295 a year, depending on the type of asset you have. So it doesn't matter to us what amount. If you're willing to pay our fees, if it's only $5,000 you put into a checkbook control, or just an IRA in general, or whether it's $5 million, it doesn't matter to us. The fees, as long as you're willing to pay our fees accordingly, then it doesn't matter to us what amount. It said, someone said, I thought we recommended a checkbook LLC. We do not recommend or not recommend any particular structure for an investment. Now, certain times and certain investments, a checkbook LLC can make a lot more sense. It's still not required. And it's not ever our recommendation, like that you should do this particular structure or not. But again, if you're buying auctions, you're buying properties that lien, buying tax liens, doing a lot of different transactions, a checkbook LLC can save you in administrative fees and can make things easier for you. Doesn't mean you have to use it. This means it could be something that could be more beneficial to you. Ultimately, that is your decision. Someone said, can I convert a Roth IRA into a traditional IRA with Advanta? What are the fees for that? I think you might have the question a little bit backwards. You can convert a traditional IRA to a Roth, which means you're taking the pre-tax traditional IRA, moving into the post-tax Roth account. You pay the taxes due on the value that's moved over. We don't charge any additional fee unless there's a re-registration fee. We can open up the Roth account, move the assets over. There might be if we have to re-record a deed to transfer title or transfer ownership of an asset, there might be some associated fees for that. Question, will you clarify what the difference is between a solo 401k and a self-directed IRA? Now, yes, a solo 401k is for individuals who own their own business. Basically, what the 401k allows you to do that an IRA doesn't is make much larger contributions. So if I own my own business and I have, say, $100,000 of salary each year, that's my compensation, $100,000. If I had a self-directed traditional IRA, the most I could contribute to an IRA is only $5,500 a year. If I instead open up a solo K because I'm self-employed, I don't have any other employees, I can defer the first $18,000 of my salary into the plan, and I can do a profit sharing match of up to 25% of my compensation, or an additional $25,000. So one of the biggest differences between the 401k and an IRA are your contribution limits. So $100,000 of compensation with an IRA, my max contribution is $5,500. With a solo 401k, it's up to $43,000. As well, 401k plans, you can borrow from them. You can actually take a loan from your 401k, even if it's just a solo K. You cannot do that with an IRA. And one of the other main differences I mentioned earlier, if you have a solo K plan, you have the option to do your own record keeping and have your own checkbook with that. You can simply lease our plan and open up a checking account at a bank and be your own trustee of the plan. The IRS, though, requires, if it's an IRA account, that you have a valid custodian, whether that's Advanta or someone else, holding and administering your IRA account. If I go 50-50 with a friend on a house that we are not allowed to do the work ourselves, is that correct? The answer is yes. As long as your IRA owns an interest in that property, whether it's 50-50, whether your IRA only owns 10%, you are not supposed to do any of the physical work on the particular property. Does Advanta have a forum where investors can communicate with each other and combine assets for projects? Unfortunately, at this time, we do not. It's something we have to be very careful of, that we are not putting people together, putting people in particular investments just from a liability and from a regulatory standpoint. That being said, we do offer our live seminars. If you are someone that's close to our offices in Atlanta or Georgia, you can come to one of our live lunch and learns and certainly meet other people. And we also are very active in the real estate investor associations in our local areas, where we go and attend meetings, we attend groups. A lot of times we are asked to be the speaker and do presentations like the one you've heard today, where you can certainly go and meet other people. So currently we do not have that forum. We do, again, some networking events from time to time and host those as well. Look for those when they're available if you're close to one of our offices. The question is, can you be taking distributions from the IRA while still making investments with no age limit? The answer is yes. So we have several clients actually who have an investment, say it's a piece of rental property where they're getting a rent check in each month from their tenant, goes into the IRA, and they in turn ask us to distribute a portion of that out to them. So there is no restriction on doing that. There is no age limit. The only way age comes into the play when doing distributions is if you are under 59.5 with an IRA account, you can be subject to a 10% early withdrawal penalty for pulling money out of that account prior to 59.5. Once you're over 59.5, that 10% penalty goes away, and you can pull money out, and then it's just whether or not that distribution is included in your income, depending on what type of IRA you have. So we have plenty of clients that are past 59.5. They receive income in on their investment. We deposit to the account, and we in turn issue that distribution back out to them. That is certainly possible too. The only restrictions sometimes regarding age in an account as well are you can no longer make contributions. So again, you can contribute up to $5,500 or $6,500 a year into a traditional IRA. At age 70.5, you can no longer take or make those contributions. But as far as distributions and investments, there is no particular age limit involved. Well, we've gone way over on time, mainly due to the tremendous amount of questions we had today. I really appreciate those. It helps drive the conversation. We'd like to certainly extend the conversation with you more. If you have additional questions that were not answered in today's presentation, if I wasn't quite clear on something that you asked, please do reach out to me. My contact information is here on this last slide. You can call, you can email me. I'll be more than happy to get those questions answered for you. And we'd, of course, love to see you at one of our events if you're able to make it in our Tampa or Atlanta office. So again, thank you everybody for attending today. And if you're watching the recording, please do reach out to us to get your questions answered.